So I'll tell you two things, Anthony. Number one is I keep going back and talking to people about this amazing article I read. I think I mentioned this already 5 or 7 times in the past 2 weeks. There's this phenomenal blog on Substack. It's called Market Sentiment. I don't know if you're familiar with it or not.
Yeah.
It's not super popular, but they write some of the best shit on the internet. And they have a piece called Buy the Dip. And in that piece, I don't know if you had a chance to read it or not, but you can actually take a look after the show. They're doing the statistical analysis of how different behavioral approaches to investing panned out post 2000.com crash, 2008 subprime crash, and the mini crash in 2020 pandemic, and how three different people with three different ideologies, methodologies have worked out from the 2000 until 2022 combined. And the three approaches are: get out of the market, stay in cash until things get better, stay in the same stock you are, but do not increase your position. And the third one was DCA into good companies. So obviously you shouldn't expect the answer. DCAing into good companies was exponentially better than any other option, but it's a little bit misleading because it has one assumption, which is, I think, the most critical part of DCAing. Everybody knows DCAing into good companies in weakness of market macro is the good approach. But the problem is, if you know that statistically 80% of companies right now will not be here in 5 years post this crash, how do you find those 20%? This is what I'm excited about right now. This is where I know that, and I had yesterday on my show, I had Patrick by David. I don't know if you had a chance to watch that interview. And I was kind of picking his brain because he kind of shares my sentiment that the next couple of years are going to be a festival. It's going to be a shopping spree. All these cheap companies are going to be up there for grabs. But we know that 8 out of 10 will not be here in 5 years. But the 2 out of 10 that will remain are going to Amazon the fuck out of the next decade, because it's going to be an open market. A lot of the competitors are gone. Money's not so cheap, et cetera, et cetera. So the conditions are completely different. So finding those 20% is where I'm super excited right now. This is all my energy recently, is just trying to figure out which one of these is the survivor. And I've developed this kind of system where I'm looking for the perfect company as far as to get up. So the idea here is I'm not concerned so much about the stock prices at all, because they be whatever they be. I don't care. I'm concerned about the business. Which businesses will survive QT, as you mentioned? Which businesses will survive a credit crunch? Which businesses would supply reduction in margins, reduction in demand, reduction in basically spending, et cetera, et cetera, et cetera. And the way I look at it is like there's this very simple way that I analyze companies right now. So my perfect company to fit this profile would be a company with extremely high pricing power, which means their product cannot be discretionary by definition. It should be, because if you have high pricing power, that means a lot of these costs will get rolled over. Number two, it has to be a company with decent and above margins, because some of this inflationary spike you'll have to absorb. You have to have the cushion to be able to do it. You can't roll over 100% of inflation on clients. Well, you can if you're like the oil companies, but anything else is like you can. Number three is how much capital intensive is the company. So how much capital they need to operate on a daily basis, because capital is about to get fucking scarce, my guy. People don't remember, in times of crisis, banks are like fucking tight ass as fuck, bro. There's no money coming out, and the little that is, it's so fucking expensive. Whether it's in the same thing in the equity market, if you're trying to raise round A, round B, round C, whatever the fuck round you, like when in tight markets, people are not giving away money like candy like they used to. So I'm looking for a company that doesn't require a lot of capex. Like, for example, I think like infrastructure, like construction, companies like airlines. But by the way, airlines have shit pricing power, shit margin, and lots of capital. Like they're the worst inflationary stock ever, bro, to think of, or recession, right? Airlines is like the worst of them all. So capital has to be minimal to operate. it has to have low financial risk, as far as if you, in case they need money, so the money could be made available. If you have low financial risk, hence, like, for example, like sustainable, consistent free cash flow at 15 to 30%, high cash, low debt. So that means low financial risk. That means it's low financial risk, basically means survivability. Basically, they're not going to go bankrupt, but also access to capital. And the final part is I'm looking to correlation almost zero for energy prices and commodity prices, because those are about to spike like a fucking Russian teenager's penis in a Thailand whorehouse in the next year, bro. So this is above 18, of course, everything we're saying. It's not a kid show. So I just want to be clear about it. Or 21, whatever state you are in. It's just a joke. It's a joke. It's a joke.
I told you not to mention that.
Yes, I'm sorry.
Don't tell us what you do on the weekend. Come on.
No, it was. I was just repeating your story that you told me
Oh,
off
yeah,
air.
okay.
Anyways, so I just described Palantir to you. Like when I did this analysis, I wasn't thinking about Palantir, but I was like, when I did this list, I was like, oh shit, like Palantir would fit right in, Tesla would fit nicely in, because like Tesla, they have discretionary products, right? That's the way would you say, well, it's not necessity. Well, if oil prices are high and gasoline prices are high and electricity is much cheaper, then there's a big demand for electric vehicles, and they hold about 66% of the US EV market. So, so Tesla is like it's there, but I think Palantir, for me, they check every box. Massive deal flow, 3.5 billion of unfulfilled contracts, 2.5 billion of cash, no debt, 30% free cash flow margin, sustainable, consistent over the past few years. Government business is 50% of their 60% of their business. It's pretty much guaranteed. Even with what's going on now, dude, it's gonna grow. Like Europe is gonna jump in, Japan, like you saw the tweets. Like, so government, like 60% of the business is guaranteed. The other 40% has a 3.5 million backlog of things they haven't done yet. And they have a net retention of 124%. Top 20 clients are paying $45 million per year for this shit, which is like a 25% increase from last year. So their top 20 clients are paying now 25% more, paying almost 15 million a year